The Walt Disney World Company is set to release its first fiscal quarter of 2023 earnings report in less than 2 weeks on February 8th at 3:30 p.m. Central Standard Time. We're going to be covering it live here on Valliant Renegade with our reactions and breakdown. But as is typical at this point in earnings season on Wall Street, we're starting to get some semblance of what analysts will expect from the Walt Disney Company and some thoughts on how Bob Iger will handle the earnings call. Let's talk about that. Renegade Online. Well, welcome back. Another great day here at Valliant Renegade. It's great to see everybody out there once again. And if you are like one of the many folks watching this video not yet subscribed to this channel, please make sure that you are subscribed. And make sure that you hit that notification bell so you get updates on when we release new videos. Hit that share button, hit that like button for this video, and do leave a comment before you head out the door today. Newly reappointed CEO Robert Iger and the Walt Disney Company are set to release earnings on February 8th after the market closes on Wall Street. Now, this will be the first time that Robert Iger has returned after Bob Chapek was unceremoniously fired back in November of 2022. We covered that night live here on Valliant Renegade, and it was a fireworks show to be sure. And I don't think this upcoming earnings call on February 8th is going to be terribly different, and the analysts seem to believe that as well. Let's read a recent report. From IndieWire, on January 24th, Disney's next action blockbuster opens February 8th. And guess what, folks? It's not an MCU title. It's Bob Iger's Q1 earnings report for 2023. Now, as a quick reminder, Disney's calendar year and their fiscal earnings year do not align. Now, many companies on Wall Street, the publicly traded ones that you see on places like the Dow Jones Industrial, where Disney is part of the Dow 30 components, and the NASDAQ, the S&P 500, so on and so forth, many of them have calendar years that coincide with their fiscal years, meaning their fiscal years run from January 1st to December 31st. The Walt Disney Company is one that has a fiscal year that is not connected to a calendar year. Disney's fiscal year begins on October 1st of each year and runs through September 30th of the following year. So the report that we're going to get on February 8th is the first fiscal quarter from October 1st to December 31st, which is their first quarter for fiscal year 2023. The Walt Disney Corporation doesn't report fiscal Q1 earnings until Feb 8th, but investors, analysts, and reporters might want to start mentally preparing now. Equity analysts at Wells Fargo expect recently reinstated Disney CEO Bob Iger, quote, will come out swinging in an action-packed conference call scheduled for 4:30 p.m. Eastern Time that day. No one quite knows the power of magic like Iger, who first steered Disney from 2005 to 2020. He's back to make a splash, mountain, and to undo some of his predecessor/successor, Bob Chapek's perceived mistakes, especially as they pertain to streaming. Chapek went all in on streaming, perhaps a little too all in. Early on in his brief and troubled tenure atop the New York Stock Exchange traded company, Chapek released overconfident subscriber guidance for Disney's streaming business, earmarking 230 to 260 million Disney Plus subscribers by 2024, the same year that Disney Plus was supposed to become profitable. The former target is likely to be walked back, Wells Fargo wrote in a Tuesday note to its investors. Now, as I've stated many times here on Valliant Renegade, it was Bob Iger who turned Disney from a theme park and movie studio company into a streaming service, because he launched Disney Plus at a time when Wall Street analysts looked at streaming companies as the future, and the almighty number of subscribers was the end-all, be-all, ultimate measure of success. And as I have lamented in the past year, Wall Street would indeed eventually make a turn from subscriber numbers to value. What is the profitability metric of that number of subscribers? And as we have seen, indeed, in the last several months, Wall Street analysts have been making that turn, now looking for value, now looking for profitability with streaming services. And I think Robert Iger, as I've mentioned before, is going to use this to his advantage, saying, well, I wasn't around the last 11 months. Bob Chapek was the guy in here, and he made all this mess. I'm going to try to come in and clean it up. Be wary of articles that seem to suggest this, because as we've covered very much here on this channel, Bob Chapek was just as much of a victim of Robert Iger's former CEO stewardship as Robert Iger is now claiming that he is of Bob Chapek's. Disney Plus ended September with just over 164 million subscribers, and streaming growth at all costs proved to be, costly. While Disney Plus added slightly more than 12 million subs in Q4 22, the DTC business lost a whopping $1.5 billion. By contrast, Iger's bottom line will be the bottom line. Another problem that Iger would like to nip in the bud is the face of Nelson Peltz. The Trian Management CEO has desperately been trying to join the Walt Disney Corporation's board of directors since last summer. He had Chapek's ear, and according to current Disney management, he had no relevant knowledge or good ideas. Now, I'll take a break right here and remind folks that just in the last few days, we released a very extensive video on the Nelson Peltz situation. I promise you it is very much worth the 30 minutes of your time if you're interested to learn what is really going on right now with the Walt Disney Company and what I believe played a significant impact on Bob Chapek's release from Disney in November. And it's also going to play a significant impact during the stockholder meeting for sure, even if it's not brought up during the scripted session of the quarterly report. It is going to be brought up in the question and answer session that will follow, I promise you. And as I always remind folks out there, the Q&A session on these earnings calls usually entails far more fireworks than the scripted portion. With a battle looming, Wells Fargo wrote that Disney management's, quote, best avenue to defend against activism is a higher stock price. Shares of Disney stock are currently trading at 106. Wells Fargo's price target for Disney is 125. The quickest path to a higher stock price is lowering costs, which means scrapping Chapek's ambitious goals. Moves likely to be reversed include Chapek's DMED, Disney Media and Entertainment division, that was headed by Kareem Daniel, folks, which removed power from creatives as well as his staunch stance against spinning ESPN off from Disney. Iger is more open to that idea than Chapek was, and Wells Fargo believes it's both the right move and an inevitable one. Now, that's something else I've discussed here. If ESPN is actually removed from the Disney corporate hierarchy, it is not going to be sold off for cash. It is going to be spun off, as this article indicates, but there's still no guarantee that that is going to happen. Disney has been historically reluctant to spin off or even sell properties of this magnitude. ESPN is a major revenue driver for Disney. In fact, ESPN, when it comes to revenue driving, puts studios like Marvel and Pixar and Lucasfilm combined to shame. This final section of the article, however, is key, and this is what people are really going to be listening for on the earnings call on February 8th. For starters, Wells Fargo believes that Disney will announce an aggressive cost reduction program for its streaming business, seeking cuts of about $2 billion or so. In anticipation, the bank is trimming down its own Disney Plus core sub estimates, not including Hotstar, for fiscal year 24 from between 135 and 165 million to 126. If this all plays out, it believes that Disney Plus will be profitable on an operating income before depreciation and amortization, so not net income, basis in Disney's fiscal third quarter of 24, which ends June 30th of that year. Over time, we expect Disney streaming efforts to converge into a single bundled service, creating a global duopoly with Netflix, Wells Fargo wrote on Tuesday. By 2025, Cahill of Wells Fargo foresees total Disney Plus, including Hotstar, Hulu, and ESPN Plus, combining for 365 million subscribers. Even Bob Chapek would do the hot dog dance over that estimate. But not to be outdone by IndieWire, the crew over at Yahoo Finance also had a few words to say about this Wells Fargo analyst's report on the Walt Disney Company.
This will be Bob Iger's first earnings call since returning as CEO in late November and shocking, really, the business community in doing so. Wells Fargo's media analyst, Stephen Cahall, really one of the best media analysts out there in the street, thinks Big Bob will come out swinging. He says this: "We think Disney management will come out swinging on the earnings call to fend off criticism." Cahall sees potentially close to $2 billion in cost cuts from Disney. That would be Bob Iger is not known for cutting costs at Disney, but that'd be a real, just a major cost-cutting plan put in by Iger to just drive better profits, notably at the direct-to-consumer business. I think Nelson Peltz is going to get on this Disney board come hell or high water, guys. I think he makes a lot of great points. His presentation on about reclaiming Disney makes a lot of sense to me. I think it makes a lot of sense to investors. I think Nelson wants to come in there and help drive better productivity inside of a business that has not been focused on productivity through the years. And he has shown a proven track record of turning consumer products companies around.
So there you go. Brian Sozzi of Yahoo Finance believes that Nelson Peltz indeed is going to get on this Disney board one way or another, come hell or high water, in his own words. And that Iger certainly does not want him on the board, that much to be sure. And we have covered that extensively here. Mr. Sozzi, Valliant, Renegade, and our crew are in total agreement with you. Well done, sir. And good job to the crew at Yahoo Finance. So there you have it. A lot of fireworks and perhaps a lot of cost cutting in the billions on the streaming services alone, mainly Disney Plus. What could that look like? We know that Disney Plus has been spending a ton of money, not only producing original content that has been getting relatively mediocre results for its production budgets, but also licensing out films from places like Pixar and Marvel Studios that either do or do not go to the theaters. And if they do, they have very shortened windows before they hit streaming services compared to traditional theatrical releases of decades past. All of that is going to come into play. There has to be a price to value ratio, a cost to value ratio of everything that any company does, including the Walt Disney Company. And it looks like streaming is the next thing to go under the microscope, as it should have been for the last several years. Let me know your thoughts in the comments below. Make sure you like the video. Make sure you are subscribed to this channel. Turn it from red to gray if it's not gray already. And please make sure you share it out and leave a comment before you head out the door today. And stay tuned here. Set the notifications up. February 8th at 3:30 p.m. U.S. Central Standard Time, we will be covering live the Walt Disney Company earnings report, once again featuring newly reappointed CEO Robert Iger. Get ready for the fireworks, folks. It's going to be fun. Take care.